Hello, I'm Niraj Mulani, the Director of Community at Product10x. Welcome to a new series called Founder First Fridays, where we share practical advice with the founder community. And today we are discussing the third quarter report from the Silicon Valley Bank that came out recently, specifically focused on venture funding and the startup ecosystem. And we have Suresh joining in, who's the founder of Product10x and Salestable.AI. Welcome, Suresh.
Hi there, hey Niraj. Nice to meet you here.
Yeah. So we'll jump right in. From the report, we figured that the early stage venture performance continued its downward spiral from the heights of the post-COVID bull, and the deal volume decreased to levels not seen since the onset of the pandemic. Should we really be reading this as a recession? So many media outlets are making it to be. Or is this more of a return to normalcy after the bloated market valuation of post-COVID?
Yeah, absolutely. That's a great question, Niraj. So first of all, I think what we are seeing in the market is it's a 10 years of bull run, right? Unheard of for sure. And those who is in the 2007 time, I'm sure, I think 2022 seems to be a similar one. But from a startups and early stage investments, and as well as founding a right startup at this point of time, seems to be absolutely a great thing to be doing, because some of the best companies that you see out there, whether it is about Uber, Slack, and many more, they actually came out of 2000 and 2007 time frame. So from that angle, whether it is a recession or not, probably I will leave it to the economists. But then from the correction point of view, I think the valuation correction is definitely much needed at this point of time, because we can't be really having $1 billion valuation for companies that are generating zero revenue or bleeding millions and millions of dollars every month. And that's one thing that I see. One positive side of whatever is happening right now is good thing for the correction and good thing for the startup founders who really want to start a startup at this point of time.
And while in the previous quarters, the slowdown in the deal volume was primarily seen in the later stage deals, for Q3, the deal volume was seen reducing at all funding stages. Why do you think that turbulence in the broader market has now trickled to the early stage startups as well?
Definitely. So the one thing that we see, or especially in the 2022, is that the whole of the Series A plus is what that got affected in the Q1, Q2, as well as Q3. And here is the reason, right? Clearly, the moment somebody goes to Series A plus, in a way, B, C, D, in a way, everybody is really looking at growth from the point of view of either the user growth or the revenue growth, for sure, but more so on the revenue side of it, because once you go to Series A plus, you are definitely looking at the revenue growth. And if that is the case, clearly, because of the natural fears that are happening with the recession fears, with the media and the public markets, how they are responding, the entire world in general on the stock market side of it is not really a great scene. But at the same time, of course, the venture capital is what we call as the non-correlated investments, right? Sometimes the VC investments are not really correlated to the public markets, but at the same time, there is that dry powder, what we keep calling as $390 billion of dry powder that is out there, that is yet to be invested, because all the LPs and the VCs have basically said, hey, you know what, we don't know what's happening out there in the market. So yes, let's wait and see to be able to invest. And what's that trickling down to Series A plus companies is to say, if I really grew much faster in the last couple of quarters, then now all of a sudden everybody is talking through all the way from A16Z to Sequoia that everybody needs to be cash positive, and then make sure that they have the revenue focus going forward, as well as they need to have at least 24 months of the runway. Now, that's really where all these Series A plus companies are really looking at and saying, oh my goodness, you know what? We hired all these people thinking that we'll grow much faster. But now, if I have to really focus on revenue, that is number one. Number two, we also need to understand that the customers are also pausing their investments now, right? So it's not just with your plans, but it is also combined with the macroeconomic situation that is happening. That's where Series A plus, we definitely saw that decline in the overall valuations per se. That's number one. Number two, on the other side, which is really pre-seed and the seed rounds, are relatively less affected compared to Series A plus, is because of these reasons, right? Which is to say, especially in the pre-seed and seed rounds, you're really looking at, hey, you know what, there is this problem that I identified. I want to make sure that I define this problem well with my product, and I have a team, I have this sales readiness, sales that I'm really doing, and then I'm seeing the early signs of, let's say, product market fit, right? That's really what we are trying to do with pre-seed and the seed rounds in a way. And that's exactly where the expectation point of view from the VCs is not as though that you are growing at a super fast pace compared to, of course, in Series A plus. And that's really where you see some of these firms, whether even the LPs, some of the LPs who do the direct investments, they are really reaching out directly to these early stage startups. Just they are able to invest in them at this point of time. And as they are growing, of course, as you can see, the investments and the opportunity grows. So that's really what is happening with the pre-seed and the seed funds. Actually, in the same report, Niraj with the Silicon Valley Bank, they actually put out great slide deck. Let me just probably share it with respect to what it means, right? The top table that you are seeing over here is really about the Q3 of the median valuation versus the bottom one is from the Q2 of this year. The one thing that you would notice is within the pre-seed and the seed, these are the quartiles that we see on what is the valuation that they are really looking at. And that's exactly where, if you see, compare between the Q2 and Q3, between the pre-seed and seed, there is very little, or I would say probably practically there is no change at all, except that from the pre-seed, previously it was $6.5 million valuation at a 25th percentile versus 6 million, a slight decrease in the Q3, but otherwise pre-seed and the seed almost the same. But however, when you see Series A, B on, let's say, even if you just look at the 75th percentile, there is a significant dip in Series A. For example, this is almost about a 20% dip that you see. The same thing is from $400 million to $300 million dip in Q3. So that's really where you see that pre-seed and seed at this point of time are still unaffected. And I would absolutely believe this will continue so in the next quarters as well. There will definitely be a small change, but if you are a founder who is looking into this, make sure that if you have a great idea, this is the right time for you to start a company and then live your dream. Pre-seed and seed will be that, and Series A and Series B, as you rightly pointed out, definitely will keep seeing a little bit of dip, I think, as we move into the Q4 as well as a Q1.
Right. And I think you're spot on when you mentioned that, especially founders that want to go ahead and pursue their dreams, this would be a good time. But in terms of founders who've already entered the ecosystem and they are still early stage founders building the product, how would they read this situation in terms of the median valuations for pre-seed and seed still being fairly consistent across the quarters?
Yeah, definitely. So there are a couple of things for founders at this point of time, right? One is to say, there are definitely a lot of founders who probably have our post product or they are about to sell and whatnot. So at that point of time, we just have to be super focused on your ideal customer profile and make sure that you have a way to reach out to these ICPs. That's number one. Let's say this is the economic situation where your ICPs are not able to invest that time or even the subscription fees or dollar amounts in your product, then make sure to research and see if there are any adjacent ICPs that you can target at this point of time and still make sure that you find those early signs of product market fit. That's super important because most of the founders that we see, just because the one particular ICP that I am really looking at is not able to convert, they actually go in the death spiral because that's not happening. But it is always important to be able to look at what are the other ways that I can really validate this product from the other ICPs that I clearly thinking through what we call as the adjacent ICPs, and then go after them. That's number one. Number two, there are a lot of companies, for example, they bet a lot on having the right product, which is actually great. But at the same time, there are a lot of, let's say, innovative features that they really try to put in the roadmap, and that's what they are executing on. So at this point of time, it is a very important thing for each and every founder or the founders to really look into your roadmap and then say, what is it that we can still provide a value without really adding new features? Because at this point of time, clearly your focus should be to bring in as many customers as possible, provide as much of revenue as possible for yourself, rather than thinking through a lot of product backlog with net new features. Or even sometimes the one big, or rather the one of the mistake that the founders do is to say, oh, you know what, this is the time that I should be having multiple products, and then they start building more products instead of focusing on the product that you have. And what that does to your startup is, again, it goes into the death spiral, because the first product that you built, it has some customers and then it has some usage. The more and more you are diverting your attention from that product in building net new other products, then you are basically starving your energy, resources, and invention into the product that is actually making you must come in, use the product and everything. And that's really where we absolutely advise any founder to focus on what is getting you the revenue, what is getting you the customers, and then double down the efforts on doing that more at this point of time. And finally, previously the mantra was to say, bring in more users. But then at this point of time, I would say, provide more value. That's super important, because at some point of time, just having a million users out there only when 1% of the users are using your system is probably of a not great value for you. But whereas even if you have 10 users, let's say, if those 10 users are using your system as intended, they are using it every day, they are realizing the value, that's what you really want to focus on, and not worry about the number of users that you have and whatnot.
Right. I think that's quality advice. And in terms of doubling down on the revenue lens as well, and with more and more startups and founders now focusing on revenue and improving their runway, a lot of them are actually resorting to payroll management to really improve their and reduce their burn rate. What do you have to say about that in terms of this current scenario?
Yeah, especially when in the Q2 and Q3, we've seen, unfortunately, there are so many layoffs that are happening across the world, and especially in the US. We just heard about 42,000 layoffs just in alone. And that's not a great place to be for an employee or even for the founder, because the one thing that we definitely have to acknowledge is, even from founder's point of view, it is not a great place to be in to really say that somebody being laid off, those people are the best employees that you may have, the best people that you worked with, your friends and whatnot. Because especially in the early stages, you are actually bringing in your friends of friends, your reference of references into the company. And it's a very hard thing for anybody to do. But what's really happening is, because everybody need to choose between, do you need to survive or do you need to die? I think that's unfortunately the hard metric that everybody is looking at. And with that, what happens really is to say, okay, if I'm really looking at my technology product strategy, do I really need, let's say, 10 of my engineers? What is it that I need to really focus on? What can I bring on at a later point of time? That's number one. And even from, let's say, the sales and marketing point of view, who is the core that I really need, who is not. So at this point of time, everybody is making super hard choices on who they need to keep versus who they need to let go. And that's exactly what you are seeing in the last couple of quarters, and especially more so in Q3, that a lot of hard choices are being made, and that's exactly is what is reflected in the SVB's report as well. In the Q3 that you see here, a lot of these consumer enterprise health tech, as you see from Q2, Q3, they have actually spent less on payroll. Clearly, this is actually a result of reducing the workforce, and unfortunately, sometimes even means letting go of employees and whatnot. But however, when you compare the same thing in the Q2, the trend was as though that we are actually increasing the payroll and the growth is upon us. But that's unfortunately, that's what we see in the Q3. And what this means for the founders, of course, is to really think through in a deeper way and say, yes, even though I have the next 18 to 24 months of runway, do I need everybody that I have in my company at this point of time? And clearly, it is a very hard decision for any founder. But if you don't do it now, then you are only spiraling the spend, and hopefully the combination of the burn rate that you have and then the revenue that is coming in, you will be able to justify the people who you have at this point of time. The last thing that I would say is, don't assume that by next year, Q1, Q2, things will be great, and then we are able to again go and fundraise. But just assume the worst case scenario that you are not able to fundraise in the next couple of quarters. And the question for you that you need to answer is my revenue health as well as my team health are good in a way that I'm able to survive for the next 3-4 quarters? And that's exactly what you should be answering for yourself at this point of time.
I think that's amazing insights for our founders. Thanks a lot for jumping on, Suresh. Good insights, conversation, this latest report. And yeah, we'll keep this going. We'll hopefully keep getting a lot more insights for our founders and sharing practical advice for the larger startup ecosystem every Friday.
Sounds good. Thanks a lot, Niraj.
Thank you.
Yeah.